Jerome, how are you?
I'm doing well. How are you?
Good. So I saw an interview with you, I believe it was February of this year, 2024. And yeah, you had a lot of conviction when you said this. You basically told the interviewer, you said, the market wants to go up. I thought the market wants to go up. Wow. And here we are now. The U.S. market has just been on a tear. It's especially compounded around the Mag 7 names. How did you know the market was going to go up? Are you the Oracle of Bay Street? Like, Jerome, you got to tell us.
Uh, no, I think it comes down more to animal spirits in that, it's also why we show up at work 5 days a week is that you are in sync with kind of what's happening on the street. You talk to people, you're getting your coffee, you bump into someone you know, and just the feeling more than anything. Like it's not as if there was any particular compulsion where we really thought on a macroeconomic level the market's going to go up. It just felt like the market wanted to go up, and people wanted the market to go up. And I as sophisticated as we like to pretend that we are as investors, that does actually matter at some point. And I think the market really wanted to go up this year. And to be honest, I feel the same way about next year. Is that everyone's happy the market's going up, rates are coming down, and people feel more positive about the stock market in general. So, hopefully replicates itself next year.
Yeah, and you made that call in Feb when no one knew that Trump was going to get in. Now, when we look at the Canadian market, do you feel the same way in 2025?
Well, to be honest, the Trump election was a disaster for us because we had cannabis stocks, which went down 50% the next day. And I was also short Tesla, so that didn't work out too well for us either. But I do think it's likely that we're going to have a change in government in 25. That the market's not really pricing in when that's going to happen, but I think the market would like to have it sooner rather than later. And so I think it will be a positive catalyst. I think the election of Trump is, the market has acted very positively about that event. And I think we have to be very cautious about that because, to be honest, in his first term, I found him to be a bit of a menace to markets. About you'd be going along. Normally, the market determines itself by about 10 o'clock or 10:30 in the morning, and something would happen at 2 o'clock, and be like, "What happened? What did I miss?" And it'd be like, "Oh, some tweet from Trump." Like that's not positive for markets. And so maybe his overall policies people hope will be there, but he likes to insert himself in the marketplace and not necessarily in a positive way.
So you expect the government to change in 2025 in Canada to pure Polyev conservatives. Have you started thinking about what sectors could benefit in Canada and what sectors won't benefit from that changeover?
Oil and gas. Oil and gas absolutely will benefit from that. And so we famously said we gave up on all resource stocks in 2012. We said no mas. We had enough of them. We didn't like them. And so it was only about 2 years ago that, well, probably the catalyst was when oil went negative in COVID. We thought, doesn't get much better pricing than that. And so I actually bought some Exxon PA in my mom's account. And then a couple months later, I was like, damn, I wish I had done that for the funds. So started looking at them more seriously. And there was one of our investors is in Saskatchewan, and I used to talk to him regularly. And he said, are you not tempted to look at some of the oil and gas names? And we kind of quietly admitted, yeah, we are pretty tempted. And you look at where they are right now, like there's just unbelievable value in the oil patch right now. And so we, about 2 years ago, went back into the sector, oil only. We don't do any natural gas. We still don't do any mining or any forestry or ag, but oil to us is just super cheap. We love the newfound discipline that's been taken over the sector, and we just think it's a great place for investors to be.
So I'm hearing that your mom's going to be risk on oil, Canadian oil stocks in 2025, and that might be the same case for Lightwater Partners. Can we talk about the meaning behind that name? Why Lightwater?
The answer is I have no idea. I actually was brought on to Lightwater Partners when they were starting it. So in 2007, I was going to launch my own hedge fund, and I had Scotia as our prime broker. And then there was these three guys from Lightwater, called Lightwater, who were going to take Toronto by storm. So there was one guy who'd sold his hedge fund in London, England to Man Group, which at the time was the biggest hedge fund there in the world. And there was another guy who worked for the #2 hedge fund in London. And then there was another guy who came from JP Morgan in New York. And they were going to take Toronto by storm by bringing in a New York-style hedge fund to Toronto. And so when they went to launch, they didn't quite think this through too well because they realized they needed a portfolio manager, and none of them were qualified to be a portfolio manager. So Scotia said, well, why don't you go talk to these guys at Lightwater, and you can be their PM. So I was picked as their PM, and so we did well in 2008. We were up about 4% when the market was down 35, but we were exclusively running offshore money at the time, and our 4 key seed investors said, hey, great job, guys. Only other hedge funds are down, so guess which one I'm going to redeem. So when we got our seed investors said, well, we're going to redeem, and then we thought, well, we should probably be good Boy Scouts and tell the other 3 seed investors that the main guy was going to redeem. And they're like, well, good point. I think we're going to redeem too. So we literally lost all of our money at the outset, and they all said, forget it, I'm leaving. I don't want to stick around in Canada. And so they all kind of went their own ways. And I was left holding the bag. So I didn't actually name Lightwater Partners. I just inherited it.
Oh my goodness. So the original hedge fund you're just about to launch, did you have a name in mind for that one?
Well, I was thinking about calling it after a place near my cottage, but my brother sort of nixed that idea. So I hadn't actually got that. I was thinking about Madawaska calling it, but we didn't actually come to launching. So
Yes, it was vetoed by the brother, right? Okay, so let's get into Lightwater's investment strategy. Could you tell us, could you reveal that for us?
yeah, so we're focused on a segment of the market, which we call Canadian mid-cap stocks. And so we arbitrarily define that as 200 million at the bottom end in terms of market cap. And we came up with that basically just saying within the Canadian context, it's really the smallest stock that you can own institutionally in Canada if you're an institution of any size. So we just, for practical purposes, picked 200 million at the bottom end. For the upper end, we kind of played around with some of the numbers, but there was about 3,500 stocks in Canada at the time when we were doing the analysis. And so we picked 2.5 billion as the dividing spot between mid cap and large cap. So what that did was there was about 150 large cap stocks in Canada by our definition. There's about 450 mid caps, and everything else was a small cap or a micro cap. And so there's basically 600 mid cap and large caps, and everything else is a small cap or a micro cap in Canada. So it was very arbitrary how we came up with that definition. And because we weren't really doing resources for most of that time, you can probably divide that 450 mid caps in half. So there's approximately 200 names in our universe that we're looking at. And that's really the sweet spot that we're looking at in Canada. And what's interesting is that since we launched the firm 17 years ago, there's a lot less people looking at our space. And it's one of the few segments of the market which we can actually say has become less and less competitive and less efficient over the last 17 years. So ironically, our job is easier to identify good companies and it's easier to identify bad companies. The downside is there's a lot less money flowing into that segment.
And so why has that become less competitive, and there's less money flowing into mid caps? What's the reason?
Well, it's partly how Bay Street is structured in that, like the number of brokerage houses has declined dramatically in the last 20 years. And so it used to be if you were a brokerage house, especially at a smaller shop, you through your trading, you could break even and keep the lights on. And then corporate finance is how you made your bonus and retirement fund. Nowadays, pretty much every brokerage needs corporate finance to keep the lights on. And so it's really become a lot more deal oriented than it used to be. And as a consequence of that, if you're a mid-cap stock that doesn't need capital, you get zero attention, and analysts just can't be bothered to cover it. And so ideally, the companies that we like are capital self-sufficient. They don't get a lot of attention in the street.
And so this is important for the viewers as well. If we hone in on mid caps, like the Canadian market is so different from the U.S. market. You can just basically close your eyes, buy the Mag 7, buy the S&P 500. You can't do that in Canada. You can't close your eyes and buy the TSX 60, for example, because there's a whole lot of laggards in there. So why are mid caps the sweet spot in Canada specifically?
Well, we think it's a sweet spot because, like, to be honest, everybody in the large cap owns the same things. And so we did an analysis recently, and so we took the top 10 actively managed funds in Canada. And so we looked at their holdings, which we, it was as of June, I think was the date we looked at them. But basically, there's 23 companies which they largely all own. And those 23 companies make up about 70% of their portfolios. And so when you think about it, if you own 2 Canadian actively managed funds, you're basically overpaying for that because all you're getting is the index. And so, you don't even need the index. You can just buy the top 23. They should rename the top TSX 60 the TSX 23 because it would capture 90% of the TSX 60 in there. And so our point is that if you want to do something different than the index, you have to look at the mid-cap space. And so, we never owned a bank, for example. We never owned utilities. We don't own gold stocks. We don't own any of the railways. We don't own any telecoms. And so we are like, our correlation with the TSX market is 0.12, sorry. And, we are very different from what the index does. And if you're trying to differentiate yourself as an independent, that's really to us, it's the most logical place to go.
Absolutely. And so while you hunt in the mid-cap space in Canada, I do hear you're not very fond of the serial acquirers. Can you touch on that, Jerome?
Yeah, well, part of it is, like, I'll give you the story of a typical Canadian tech company. It's one of the reasons why that we basically don't own tech anymore in Canada. And I know some of our peers love the tech space. We don't, I'll be frank. So what happens is they generally grow their business through acquisitions, and they usually do it through equity, which gets them a little bit of attention from the street. So they'll issue shares. There's usually a 6-month, 12-month, and 18-month lockup period for those shares. But then the former executives and the former owners of those companies release them. And so that you're constantly facing this wall of capital that's coming off from guys who are in a name or in a private company that, they want to get their capital out. And so they're basically dumping the shares, and you're constantly fighting that. And it's just a never-ending stream of capital coming out. And on top of that, to grow their businesses, they all continually issue equity on top of that. And so it's just a terrible cycle. But one of the reasons why I really hate serial acquirers is when you acquire a company, it affects your balance sheet because you're bringing on board the assets and liabilities and cash flows of that business. And so you can't really judge a business when they're serially acquiring because you don't get a clean look at their balance sheet to see, for example, what their organic growth rates are or various other metrics to see what their profitability is at. And so it's just, it's not something that we find very attractive. And I know there are some great stories out there like Constellation and others, but they tend to be the exception.
And then, so I was just going to ask that. So there's always an exception to the rule, Constellation Software being one. Have you ever held Constellation? Do you hold it now?
No, I haven't. And I remember about 10 years ago, I was at a conference in Niagara Falls, and I think it was teachers had a slug of Constellation that they've held, and the rumor was they were trying to sell it at $70. So this is back quite a few years ago. And we were thinking about shorting it at 70. And Jason Donovan was at the conference and he convinced me not to short it, which is probably a good thing at $70.
Yeah, probably. It's reaching what, 5,000 per share now? I think it's almost there. Interesting.
You know, it's a great company. And every time I saw it, I was like, I love the management team. I love what they do, but I think you're really relying on a business model. It has been successful in their context, but generally it hasn't worked in Canada very well. And
when does the party end, if it ever does, for Constellation Software? If we're just, a thought experiment, does it end?
To be honest, it just got so big many years ago that it was sort of beyond our sweet spot, and so we stopped looking at it. And I do see them at conferences from time to time, and I was thinking, they actually talk a great story, and it's really compelling from a shareholder's point of view. But I look at Inghouse, which is kind of a rival of that, and you realize in both cases how key man risk is quite vital to the business. And it's a bit like Warren Buffett. Is how successful will Berkshire Hathaway be in one day when Warren Buffett passes away? And I don't know how successful Constellation or Inghouse can be without their key man involved in the business. So I don't really have an answer to
that. Staying on this topic, Mark Leonard put his son Damien into a holdco, Pine Tree Capital, and he's at the helm of Pine Tree. Have you ever heard of Pine Tree?
Yes. Yeah.
Okay. And
we used to short it.
Oh, you used to short. Okay, so why did you short it then, and why have you covered it recently?
Well, there was an individual who was running it who wasn't very friendly to shareholders. Let's put it that way, and so it was. It wasn't the best vehicle to be invested in. Let's put it that way. And it's. I'll leave it at that.
Okay, and so apparently with Damien Leonard taking over the company now, there's quite a lot of capital loss credits that they have on the books, which is a benefit I believe I've heard going forward.
To be honest, I haven't followed it closely enough, and I'd actually thought the business had gone under. So I saw a couple of years ago that it appeared on the 52-week highs and lows, and I was like, oh, didn't realize the thing still existed. But it's great to have a vehicle which has tax losses in it, and it's clearly reinventing itself under new management. So I don't really know about the particulars of it.
It's quite interesting. I believe the Leonard family owns something like, I think, 35%. The shares, the floating shares. Okay, so if we're to move on here, so you're a hedge fund and you're long and short. Can you talk about that strategy? How many stocks are you long? How many stocks are you short at any given time?
Well, so the Nimble Fund, which is it's got about 20 names in it. Typically, we would have about 13 long, say 6 or 7 short, be it sort of the average in there. And the Nimble Fund was a byproduct of our main fund, which used pair trading. And so what we did was we would split the stronger side of a pair trade and just take either the long or short, and we put that into the Nimble Fund. It was initially sort of conceived as a thought experiment about 11 years ago. And then we realized it actually works pretty well. So that's historically how the Nimble Fund has been run. But there was a development in COVID that had us change our thinking a little bit about this. And so we did a strategic shift about 2 years ago. And the reason was, I'm sure you're familiar with the GameStop phenomena.
Mm-hmm.
And people thought it was entirely a retail phenomena where you get 400,000 people and you convince them that 1 + 1 = 138, and you get the GameStop phenomena. And what happened was, I think there was actually some hedge funds that recognized the opportunity within that. And so they they kind of hid within the masses and played it both up and down directionally. And I think a few hedge funds, both in Canada and the US, started thinking about that and realized that there was opportunities for market manipulation based on that. And so we had an experience, and I think it was 2022, where we had a short position on, which we made about 65% on, and it was a strong fundamental short case. It was a roll-up strategy, a serial consolidator, which we hate, and it also had a dual CEO structure, which we hate as well. And it ended up on a Friday night in July. Usually when a press release comes out at 5 o'clock on a Friday, you know it's not good news. And they fired one of the CEOs. And so we thought, well, the market won't respond very positively to that. But much to our surprise, for the next 35 days in a row, the share price went up. It went up 400% in that point. And so when it first started happening, we thought, well, okay, I don't really know what's going on, but we want to go and short some more shares. And so when we went to go and borrow some more shares, much to our surprise, we found there was no availability. And so what had happened was that hedge fund had, before they initiated this, went out and soaked up all the borrow on the street. So they borrowed from everybody, but didn't use the borrow. And so it basically meant, well, when we wanted to short some shares the next week, we couldn't, because we couldn't do a naked short. So it's like being in a fight and having two hands tied behind your back. You can't really do too much. And so after 35 days and a 400% share price increase, we said, Uncle, you win. And so we bought shares back, and it was definitely the peak of the stock price. And then the company went bankrupt about 9 months later. So we were right, but we got manipulated out of our position. And so we thought, well, this isn't a great business model in which this can happen to you, because it cost us about 800 basis points on the year, which is a huge hit. And so it made us rethink our business model. So we do a lot less shorting now than we used to do. In fact, shorting was a core competency for us. I think we were one of the hedge funds in Canada that really made money in our short book. And unfortunately, we kind of moved away from that. So now we do hedge out very selectively, but we no longer do it within the mid-cap space. So we're only doing large cap or ETFs, which we're essentially hedging beta in the portfolio.
That's super interesting. This whole meme stock phenomena, right? You have people on Reddit saying, hey, let's just short squeeze the heck out of this stock right now. Like, to your point, it could be a company that, won't exist in 3 years, but there's just so much support to squeeze it.
Yeah, and it's interesting. If 4 hedge funds got together and manipulated the share price up, in the U.S., you'd face criminal charges. In Canada, well, nothing will happen, but in a regulated economy market, it would. But if you get 400,000 retail investors conspiring to raise the price, everyone's like, oh, this is great. This is democracy. So, well, it causes huge distortion in markets.
And they're all anonymous, right? They have names like Ape, 2001 on Reddit, right? So you have no way of tracking these people. You could do it through IP, but you'd have to be very motivated, right? As a regulator.
What's interesting is that Canada is a very small market where there's basically 6 prime brokers. And so in the instance where the share price was clearly being manipulated, we wrote to the regulator 3 times and they did nothing. Wow. And then the next spring, the same thing started to happen, and we noted it. And I wrote a letter to the regulators at about 4 o'clock one afternoon, and about 10 o'clock the next day, all of a sudden, this short squeeze stopped.
Oh.
And it was very easy for them to do so. And as I pointed out in my letter, I said, it will take you 20 minutes to solve this problem. You phone up the 6 prime brokers and you say, who is borrowing stock? Who is not using it? They are the manipulators, and it would have taken 20 minutes of detective work to figure it out. And to their credit, even though they never acknowledged it, they actually did it in this instance. And after that, we just said, no mas. We just can't do this anymore within the mid-cap space.
My goodness. So you obviously had to adapt, but when you were shorting in the mid-cap space and possibly even lower in the small cap space, I remember you mentioning on TV, I think it was a few years ago, that you hated the month of January. And why is that?
Well, we're generally long quality and short crap, and crap always rises in January. And the reason is that people do tax loss selling at the end of the calendar year. And so they buy it all back in January. And so the crap always rises in January. And the way our portfolio used to be structured, if the market was up about 3% in the month, I could guarantee you that we were not making any money. And if it went up 4, 5, or 6, I can guarantee you we're losing a lot of money that month, because, you know, your short position, your long positions will go up. If the market was up 5%, they would go up 2%, but your short positions will go up 20%. And so you really feel those when you get frothy markets. And the irony we used to say to our investors is, all your other investments are doing well in months like that, and we're definitely not going to. But when everything else is tanking, we do very well in those markets. And so we were, you know, I think since we launched 17 years ago, there's been 48 months in which the stock market has been down more than 2%, and we've beaten it 46 of 48 of those months. And we've actually been positive in more than half of those months. So when the market's down 2%, you know, we actually defend capital very well, and we can make money in those kinds of markets. So it's a good, you know, way to diversify your portfolios.
The very little correlation, as you mentioned before, to the broader market. So if we go to the long side now, for the mid cap stocks that you do select for the fund, walk us through the criteria. How do you go about doing that?
Well, the most important thing for us is just understanding what the business does. And so, you know, it doesn't have to be a great company. Like, and that's one of the things that I think differentiates us, is that we'll look at stuff that we think, you know, there may be flaws or there may have been mismanagement or something, but we'll look at that relative to its valuation. And so we just want to really understand the business first and foremost. And that's something that's very important to us. And it's one of the reasons why we moved away from resource stocks a long time ago, because say you and I go out to visit an oil and gas field out in Alberta, and we're standing beside this oil rig, and the petroleum engineer says there's 1 billion barrels of oil under here. You and I will look at each other and go, okay, I'll take your word for that. Whereas if we go to visit a widget factory in Mississauga, we go into the widget factory, you could say, well, how many widget machines do you have? How much do they produce? How long can you run these for? And we can estimate reasonably, you know, how many widgets they can produce, how much it costs. And so the ability to know a stock and a company is very important from our perspective. And we're really not bottom-up investors, so we don't have to be invested in anything, but really understanding the company and understanding the risk and understanding the upside and the valuation is crucial to us. And so the ability to understand a company is, I think, first and foremost in our minds. And secondly is just thinking, okay, here's what we're thinking. What's the street and the market thinking? And, you know, it used to be a lot easier to understand that when there was more analysts out there, but sometimes we don't even know what the street's thinking because there is no analyst coverage in that. So it's a little bit harder than that. And then the third is, how do we potentially benefit from the different view that we have on stock? So if everybody loves Dollarama and we love Dollarama, I don't think there's really any value add to that. Whereas if we think Cineplex deserves to be our biggest name in the portfolio and no one else thinks that, then there's an opportunity there to make some money.
Interesting. So you're looking for stocks that can hit a catalyst, can basically hit a re-rating in the short term, right? On the strength.
Yeah, I think that's really important because it's very, especially in our space, you know, you can have the greatest idea, but the world doesn't care. And so a great example of that would be, you know, we've had an investment in Guardian Capital since 2009. We've continuously held it for 15 years. And yet, our thesis in the stock in 2009 was all the asset managers got crushed in 2008 and 9. And so these guys held, I think at the time it was, I can't remember how many shares, 5 million BMO shares. And so they were actually trading at about a 25% discount just to the value of their BMO shares that were sitting on their balance sheet. So we looked at historically where that traded, and it was normally about a 25% premium. So we thought, okay, well, we'll go back to there when things normalize. And so it was like, so we bought Guardian and we shorted the Bank of Montreal against that. And to us, it was like a play on BMO where we were buying it for 50 cents in the dollar. And that trade worked out really well. But here we are 15 years later, and about almost 2 years ago, Guardian sold one of its businesses for $750 million. So it's now sitting on $1.1 billion in cash and securities, and the stock trades at about $800 million. And so we're once again in the situation we were back in 2009, where we think there's a great opportunity, but there's no obvious catalyst for someone else to look at and say, hey, this is a great idea. And therein lies the problem with the mid caps. You can sit on things for literally 15 years and it not, come to fruition. Because we thought for sure BMO would have taken it out a long time ago. Because I haven't. It's still been a good performer for us over the last 15 years, but it can be frustrating that no one else shares that view. And you're right, a catalyst is really important in this type of investing. You try and look for one.
So that's a great example going back to 2009, but can you, just for us to better understand your process, can you pick a recent long from this year or the year before and just walk us through the process of how you initiated and why the position?
Well, yeah, there's one that's Main Street Equity.
Bob Dylan.
Yes, exactly. Yes, Bob. We were looking at this name for a very long time, and it was probably about 2 or 3 years ago that we finally pulled the trigger and invested in the company. And really what we like about this is a play on providing affordable housing in Canada, and especially they're focused in Western Canada, which is some of the cheaper, lower income housing in Canada. And with the surge in immigration that we've seen over the last few years, it was an obvious way to play that for us. But we just like the fact that Bob has been running this company since, well, he IPO'd in 2000. 25 years he's been running this. He's got a great business model. We really understand what he's doing. We think he's really competent in what he does. And what we always struggled with was the valuation of it, because it was so much more expensive than its peers. But when you realize that, like when most REITs buy a property, they're not really adding a lot of value to that property. Whereas Bob buys them, he always buys underperforming assets. He has his own in-house construction team where they'll redo and renovate apartments themselves and then get a substantial increase in that. So in terms of the rents. And so he's, I think, just using capital very efficiently, but he's also got a niche in the market where it's kind of where you have to get your hands dirty to do what he's doing. And pension funds don't want to touch that. The REITs don't want to touch that. There's not a lot of people who want to. And so he's found an interesting niche in what he calls the mid-market segment in Western Canada. And we actually just love the story. We think it's a great growth story. We just came out with the results this week, and it's growing 24%. Income is growing faster than that. We just think companies like this are out there and just not getting enough attention.
And there's no share dilution, right? Like in recent history, it's just amazing.
Yeah, I calculated in the 25 years since he's listed, his share count has increased by 4.9%.
That's exceptional.
Yeah, and that's so rare in Canada to have someone who internally funds things, doesn't always do what we call a drive-by financing, where every time the share price goes up, you get a call on a Thursday, oh, there's a deal out there. It's like, you don't have to worry about that with Main Street. And, when we talk about productivity in this country, like guys like Bob are guys that we should look to. Like he's a great example.
Completely agree. I also own shares in Main Street for all the reasons that you just mentioned. It's just a phenomenal business in Canada. So well run. He's really figured out the business model and as you say, the niche.
But what's interesting about Bob too is you could argue he's an acquirer, but he acquires assets. He doesn't buy companies. And so it kind of helps the issue that I had with regards to when you acquire companies, you're bringing in all their assets and all their liabilities in, whereas he's essentially just buying doors. That's and he's buying them below replacement value. And that's also a really interesting model that he has. And I think it's going to persist for some time in Western Canada, where he's paying, 80% of what a new build would cost or replacement. And so I think it's a great, from a capital allocation point of view as well.
Yeah, that model might not work as effectively in Ontario, for example, right? Or BC for that matter. It sounds as though, Jerome, you've met Bob. Am I assuming that correctly?
I have, yeah. I don't know well, but I met him. Yeah, he's a bit of a character. Yeah.
Awesome. And so the reason why I ask is because you're playing in the mid cap space. Is it that much more important to meet these CEOs before you invest?
Well, it is. It's definitely a people business, and it's also interesting from a risk management point of view, because when something goes wrong, like take for example TD Bank. So you're an investor in TD Bank, and results come out yesterday. Even if you're a big shareholder, you probably don't phone up the CEO and say, "Hey, I'd like to have a chat with you about yesterday's results." Whereas in a mid cap, we'll phone up and we'll talk to them, and they'll take our calls because we want to know what's going on. And so access to senior management to us is very important from a risk management point of view. And, what we like about the businesses we're in, they're not startups. They've been around a while. And, there's a reasonable level of sophistication in most of the companies that we're with. They're just smaller and less bureaucratic than a lot of the large caps that we're in. So when something goes wrong, you have direct access to them and you can find out what's going on. The other thing is with mid caps is they tend to be more focused in the business, at least the ones that we're in. So again, I think they're easier to understand. And we like simplicity generally. We like people to do things well. And I'd rather have people do less things, but do them well.
Has there ever been a case where the CEO hasn't picked up the phone when you called?
Yeah. There's a case today or this week. So Amiat is a name we're got involved in. The reason why we got interested in it, they had $6 cash on the balance sheet, and the share price was trading at about $3, which seemed a pretty good idea at the time. Unfortunately, it wasn't, because the CEO at the time decided, well, let's go spend that $6, and he bought possibly the most expensive company ever in India, a rope company, at 11 times EV to EBITDA, which I didn't think that even existed in the Indian market. And he bought an Italian specialty chemical company about 8 times. And so the share price went, not too pleased with either of those acquisitions. And now it's trading about 270. So they announced there's a bit of a bun fight going on as well between two senior, its largest shareholder and the management team. But at the end of the day, there was an SIB announced last week. And so we sent an email and phoned the company and said, we'd like to have a meeting. They didn't respond. And we just said, you know what, I'm selling my shares. And we just dumped the shares.
That's not a good sign. It's almost reminiscent of what Bell Canada is going through right now. Like what was their dividend yield above 10%? I don't know if I've ever seen that. Aside from 2009, the Great Recession. And I think it's the CEO. He went out and bought, he spent a whole lot of money in the U.S. recently, and I don't think the street was too enthused with that acquisition.
Yeah, no, right. Be honest, we were looking at shorting the telecoms, but the yield was something that scared us off in BCE. In retrospect, it probably would have been a good short even without.
It would have.
With the dividend yield, because I thought it was just not lack of market awareness, I would say, in that acquisition. I just think the market was not supportive of that, and clearly the market reaction was very negative to that. And so, I think it's one of the things that as investors, we're not activists per se, but we like to be involved with companies. And so we're not shy of talking to management and saying, here's what we would like to see done or that. And, sometimes they listen, sometimes they don't, but usually the successful ones tend to at least listen to their shareholders.
So in terms of information gathering, you mentioned that there's not a whole lot of analysts anymore covering mid caps. So Jerome, what are your data sources? Where do you get your data? How do you pull it together to make informed decisions?
Well, filings are still very important. Like, we really believe in modeling ourselves. And so, we've been doing this for 17 years, so we have a pretty good library. Some of our models will go back 20 years now. And so I think it's having a historical perspective on it. The other is we will talk to management, we'll talk to analysts, we'll do as much digging as we can around that. But, we're a little bit different from a sell-side analyst. As a sell-side analyst, you may cover 8 to 12 names maybe within a coverage universe, whereas we're probably modeling realistically 20 to 30 names, and we probably have models that we're not constantly updating, but would be, we probably have over 300 models in our library. And so being able to tap that, but I just think people don't pay enough attention to valuation. And so we look at a variety of metrics in valuation. And we also, because we're not publishing these, we can afford to be creative on how we look at things. And so, for example, in the case of Guardian Capital, you could say, well, it's the most expensive asset manager on PE basis on the street, but then you get an incident like I think it was last week or a week before, when CI funds got taken out. It was taken out at 3.5 times book. Well, Guardian trades at 0.8 times book. Yeah. And so, which is more expensive than that? And our view was like the fact that Guardian still isn't trading at its cash and securities value means that there's a negative value attached to its operating business. And to us, that's cheap. Negative is good. And so, just looking at things in different ways. And, I used to be a sell-side analyst a long time ago, so I know the pressures and the political influences that affect sell-side analysts. And so we respect what they do, but we also understand their limitations as well.
Let's talk about position sizing. Does size matter?
Yes. Yeah, okay. For sure. One of the things, we've been talking to a family office for about 10 years, and they actually said to us, they wanted us to do some specific work on sizing. And so what they wanted us to do is said, what if you ran a more concentrated portfolio when you only ran 7 names? And I don't know how they picked that, but they randomly said 7 names of your best long only ideas. And we're like, well, I normally hate back testing, and I don't like running that concentrated portfolios, but it's not very often we get these kind of requests. So we indulge them and say, okay, we'll test it. And we were kind of shocked at the results. They were much better than our actual performance had done. So it made us think, well, should we be more concentrated? And so as a result of that exercise, we actually have increased our concentration considerably. So in the past, a position north of 5% would have been a large position for us, even though we were only running, say, 40 names overall in our large portfolio, 20 in the Nimble Fund. But we've actually really increased concentration. And so we're not afraid to have a name north of 10% now. And we actually have one position that's, well north of 10%.
Can you name names for the
Sure.
10%?
It may surprise a lot of people. It's actually Cineplex.
Interesting.
Yeah.
Catalyst is forming for Cineplex in the near future?
we actually bought it in COVID, and part of it was for a very long time we were short Cineplex. We thought it was the most over-owned name in Canada, and it was institutionally. I don't know if you remember, in 2008 and 9, it was viewed as the recession-proof stock, and so every portfolio manager owned it. And in fact, I famously had a live debate on BNN against a portfolio manager, a mutual fund manager, who took the bull view that it was worth more than $55 a share. And I said it wasn't worth 15 times EV to EBITDA. And so we actually had a pair trade where we were long Cinemark and short Cineplex. And because it was so well owned institutionally, it just stuck in a band between 50 and 55 for about 3 years. Then finally it broke, and we actually made a lot of money on the pair trade, and we covered it, and I kind of forgot about it. And then COVID happened, and they all got crushed.
Yep.
And it was interesting. We first started shorting the cinema companies because I was on a call for Cinemark, and there was 12 American analysts on the call. And this is when we were already evacuating the offices. Not one of them asked a question about COVID. And I thought, are these guys crazy? So we literally tripled our short position on Cinemark, and we started shorting IMAX too. And then we started thinking, well, Cinemark had the deal in place. So we thought, well, the deal's going to go through. So we didn't really touch that. But then when the deal fell through, when it got to around $7, we were very interested. And so we started picking away at it. When it was about 7, we participated in the deal when they did a debenture offering, I think that summer 2020. But we've been invested in the stock since really 2020 on the long side, and it's now our largest long position.
Brilliant moves. So when you do build a position to 10%, is it a gradual build up with the new strategy, or is it back the truck up because we have so much conviction? Let's just put 10% of the fund.
Yeah, it'd be very rare that we would back the truck up and do it. It tends to be cumulative over time that we'll do it. So,
what do, like, from your entire career here running the fund, what do the winning stocks have in common? Is there a common criteria? Can you put numbers to success, basically metrics?
I think they're all different, to be honest.
They're all different. Yep.
I think they tend to be simple businesses, and I think like doing something well is important. And like coming back to your original theme about capital compounders, I think the closest one that we have to that is going to be Descartes Group.
Phenomenal company. Yeah.
Yeah. And what we love is it's a play on trade globally. And I remember when we first saw it, there was an old CEO named Art Mescher, I think it was his name. And we saw him on a presentation, and it was one of the rare times that we thought we should go buy this company. And what really encapsulated it was he said, we want to be the Bloomberg, and we are the Bloomberg of trade. It's like, if you're in finance, you basically have to use Bloomberg. And if you're in trade, you got to use us. And we thought we love that. And it's interesting. So we had a debate though with sell-side analysts in, I think it was 2011. And we basically were very skeptical about the fact that they seemed to make a lot of acquisitions, and we didn't really like them. And they all seem to be kind of small tack on acquisitions. And we thought it was a real distraction of the business. We thought they were all a lot of bells and whistles. And to be honest, none of them are must-have acquisitions. There hasn't been one that they've made since we've owned the company where I really thought this is transformative, or I can understand why they do it. It's all just kind of bells and whistles. And anyways, we bought more after we had this debate with the analysts. We bought more. So we originally bought at $6.60, and then we bought some more at $7. And we added and subtracted a little bit since then. But to be honest, it's a great play on global trade. And it's our lowest maintenance stock too. And what we love about it is the fact that it has such high recurring revenues. So the CEO had this great line. He'd say, at the start of every quarter, I know what 90% of my revenues are going to look like at the end of the quarter. And I spend the next 90 days worrying about that last 10%. And it's why they always have such predictable earnings, is because they know at the beginning of the quarter what it's going to look like. So the recurring revenues, because I actually just met with a company this week, it's gone from 90% to 84%, but it's still a very high recurring number. And we just like the consistency of it. If you're going to invest in a tech stock, you want consistency.
Completely agree. It's another company that, full disclosure, I do own shares in because Descartes just runs so well, as you said. So what about the letdowns? Like, not everything works out in the fund. What are some of those, not memorable, but the letdowns of left scars, and tell me about the lessons that you learned from those.
Well, we actually had a nasty one this summer where the first Monday in the summer, I was up at the cottage planning to take most of the summer off, and much to my surprise, one of our larger positions made a press release that the CEO had absconded with $7.5 million from the company. And, it's a health royalty company, which is probably our safest bet that we had. The one I thought I would sleep easiest at night about. And it was very disillusioning because we had spoken with the CEO so many times. He seemed a very competent guy. He was probably the most articulate with regards to capital allocation in our portfolio. And for something like this to happen was very disillusioning. And, it really made us think about the mid-cap space, and that, if you're an investor in the Royal Bank, you don't worry about the CEO stealing $7 million from you. And why do we have to do that in the mid-cap space? And it I think it does, it still bothers me to this day. And
it was a people problem, right? It wasn't a stock selection problem. It came down to the person just not playing by the rules.
But at the end of the day, I'm not sure there's really anything we could have done to point that out. And it's part of the realities of the segment that we're in, is that you just have a different risk profile than others do. And the converse of that is, when you think about, like, 'cause I used to manage pension funds and institutional money when I started my career. And there's always a bedrock that you have within your portfolio. So in Canadian equities, it's you own the banks, you own the pipelines, you own other utilities. And so there's a bedrock to the portfolio that you never really have to worry about. In mid-caps, there is nothing equivalent to that. There is no bedrock within it. And so everything, when your safest position has a CEO that steals $7 million from you, makes you think. So I'm not sure what lessons to learn from that, but one of my investors said, well, you should just stop talking to management. And I'm like, I'm not sure that's a solution either. And so what I've learned for it is, you can lose money in anything.
Absolutely. So walk us through the next 3 days after you hear about the news. What do you do at the cottage, basically, the next 3 days?
Well, I always say this, and it may sound flippant, but the most important thing for a portfolio manager 90% of the time is to do nothing, is don't overreact. Try and get as much information as you can. But we actually didn't trade any shares. We didn't buy or sell any. We just try to get as much information as we can. And so we spoke to the chairman, we spoke to various other people that were involved in it, and tried to get as much information as we could, but really didn't do anything in terms of trading. And, I think it's one of the advantages of our job is that 99% of the time you should do nothing when people give you advice. And that's what we do.
Do you employ any additional short-term trading strategies to add a little more alpha throughout the year in the fund?
We We will from time to time do some, but we try and get away from it. To be honest, you tend not to make that much money on them. They tend to be just distractions. I think when we started the fund, we used to do a lot more of those. So, there's a big storm coming that looks like it's going to hit New York City. So you short the local utilities thinking it's going to flood. It ends up, you don't really make much money on it. And it's just a distraction from kind of what you're thinking, your main business activities. So we try and get away from that now.
Going back all those 20 years, I have a feeling you have more shorting stories for us. What's the biggest windfall from a short that you put on?
There was a Vancouver-based biotech company when there was an Ebola crisis in Africa. I can't remember the name of it, but it was listed on the NASDAQ, and they've been around for about 20 years. And in the 20 years, they'd never commercialized a product. And they were one of 3 firms somehow picked by the UN to help solve the Ebola crisis. And the share price went up about 120% in a couple days. And so we decided, well, if anybody's going to solve the Ebola crisis, it's not them. And so we shorted the stock, and I think we made about 65% shorting that position in a very short period of time. And it was more just because we knew the history of the company, and we historically had shorted that company because we could tell when they were in a cash burn, they needed new equity, but it was just a God gift, that one.
That's just great. And these God gifts, though, it's because you maintain a Rolodex of companies, not only in the long, but also on the short side, right? So you're continually tracking them, right?
Yeah, there's a limited universe, and there's less people looking at them nowadays. And so it's nice to have an awareness of it. And, it's like we invest in companies that are good at what they do. And I think we're good at what we do in the mid-cap space.
So there's a perfect segue. Probably the most exciting part of the video conversation here. We've talked a lot of interesting things, but your outlook for 2025, Jerome. But then especially, what are your best ideas for 2025?
Well,
Love to hear them.
I'm going to talk my own book, Cineplex. I think you're going to have a fantastic box office in Q4 and Q1. And part of the reason is, if you remember this time last year, there was the writer's strike, and I think it was the actors and directors strike. And so, it really curtailed the box office. But, we're still recovering from the COVID phase. And so there's a lot of pent up hits that are going to come out in 2025 that I think will really help Cineplex. And the other is that people are getting over the fact that, yes, Netflix does exist, but if you want to go out and it's still a relatively inexpensive night to go out to the cinema, it's going to be here for another 100 years. And so I think a lot of millennials thought, oh, Netflix is going to put the cinemas out of business. I think the big studios recognize that having the big releases in the cinemas is very important for the success of a film. And so I think the peak of Netflix euphoria is behind us.
That's interesting. Like, as we discuss this now, that's an incredibly contrarian take, right? Like, we'll see how that plays out. That's interesting.
And the other is, I think there's a great sort of anti-woke movement. And if you want to play that, oil and gas is the place to be. And on top of that, just the valuations are super cheap in the sector.
In your Rolodex, what are some of the names that you would put capital towards if Pierre is brought in, the Conservatives bring back a resurgence in the
well, I think what makes some sense for people to do is to look at the oil and gas services names. And the reason for that is you're a little less sensitive to the price of oil, because if the fears come through that Trump really encourages a lot of drilling in the States, the oil price will come down. But there's a little bit more, and it will affect the sentiment in the sector. But I do think there is better capital discipline overall in terms of CapEx. And so you don't have the boom and bust cycle that you used to have in the service sector. So they're now a little more steady in their performance. And I just think that when you're buying stuff at 2 times cash flow, you got a lot of downside protection because what does it go down to 1.8 times cash flow? Like you're very, very cheap at those levels. And these companies are also kicking out cash flow. So, I use an example like Total Energy Services, TOT, which we own. It's probably got about 450 million market cap, bought back 10% of its shares this year. It's going to buy back 10% of its shares next year, growing at 15%. It's got a 3% dividend yield on it. I think you could, there's worse places in the world to put your money.
It sounds like there's runway there, right, into 2005 and probably into the future too. Can we get a third idea then from you as well?
Or let me just think of one. How about Kraken Robotics? Have you ever heard of this one?
Mm-hmm.
It's St. John's, Newfoundland-based company, and it's kind of perceived as one of the few defense plays in Canada. There's not a lot of listed defense stocks here, but they have an interesting technology that's kind of focused on undersea, firstly batteries. So they provide some of the batteries into one of the larger sort of undersea drone manufacturers in the U.S. And they also have, and I guess it's sort of an add-on that is attached to naval vessels to enable them to identify undersea obstacles such as a mine or other things in the water. And both of them are actually relatively inexpensive for a Navy and naval procurement. And I do think that countries like Canada and the whole world recognize that we need to spend more on our armed forces, but they want to do so in an economical way. And you look at the success that the Ukrainians have had in the Crimea and the Black Sea with some of their makeshift underwater drones. I think it's really opened up a lot of eyes out there. And I know Australia has a program which Kraken is involved with. I think it's called the White Shark or something like that. And if countries like Australia are investing in this, I'd like to see Canada following along at some point too.
And did you break any rules to buy into Kraken? Because I believe for the longest time it was a micro cap, right? Sub 200 million.
Well, interesting. I had one of our former colleagues was in the Queen's Own Rifles, and so he came across the name about 10 years ago, and we've been watching it for a very long time. And so sometimes we will look at names that are much below our threshold, but we'll watch them for a long time. And it got pretty close to the 200. I think Cormark did a bought deal last summer at 46 cents. And so we bought into the deal, and it's kind of run since then. But, sometimes you get lucky and one of the stocks in your name captures the imaginations. So Kraken in the last 18 months has really had a nice run, but there's a whole bunch of names that we have in the portfolio that we're like, why don't people pay attention to these ones too? And therein lies the frustration. And coming back to your point, like you can have the greatest idea on earth, but if there's no catalyst or nobody cares, it just sits there. And that's how I kind of feel with a lot of names in the portfolio. And so, well, it's great to see a name like Kraken do really well. You're thinking, why doesn't everything go up?
Yeah, it's so true. There's so many other great small caps that are being bought out right now as we speak. There's just no liquidity in our public market, the TSX Venture especially. Are there any other notable small caps, in the Rolodex for the future that you've invested in? You want to mention?
So, again, coming back to the oil and gas space, I think there's some mid caps there that, if you look at the super majors, they're probably trading at 7 times cash flow. The largest Canadian ones are probably at 5 times, but there's a whole slew of mid caps out there that are trading at 2.5 times cash flow. And, Surge Energy would be one of those where, we think it's a good company. It's got, probably about 600 million market cap. It's got a 9% yield on it now. We used to own the debentures, and then we realized when the yield on the common became higher than the debentures, we're like, well, let's sell the debentures and buy the common. there's a whole bunch of names that just don't seem to get any love. And so at least they're aggressively buying back their shares now. But, you could do worse than owning a name like Surge Energy and get some exposure to the Canadian mid-cap oil and gas space.
What's your take on Bitcoin and any blockchain-related companies that are listed in Canada?
I stopped shorting them. I think it would be best to say I'm a non-believer. And, I view it a bit like GameStop in that, yes, it's gone up a lot, but I still don't see any value in it. Like, is Bitcoin worth $1 or is it worth $100,000? Well, who's to say? Like, there's no intrinsic value to it.
It's self-perpetuating. It's people are buying it because they want to get rich, and everyone's doing it. They're all buying, so it just keeps on going up. And I think Trump is pro Bitcoin, I believe, right now, and so that added a tailwind there. I think it just finally breached 100,000 right per Bitcoin, which is wild.
Well, on a similar vein, like if you want to invest in something like that, like go buy some cannabis MSOs, because they got crushed since Trump's been in office, and the DEA is finally going to reschedule it, and like they're trying to delay it as long as possible. But it used to be that some of these names would trade at like ridiculous valuations. Now you can get, and there's no point in going low. Just buy the largest players out there. Like truly, they're trading at 3.5 times EV to EBITDA. And I was shocked that the Florida referendum went against them in November. But at some point, the U.S. is going to realize, like, we might as well legitimize this industry and benefit from it from a full tax point of view.
When Canopy growth was at its peak in Canada, I believe in the year 2018, were you shorting Canopy?
Yes. We were famously short. It's one of the reasons why we got kicked off PNN.
Tell me about that.
Kicked off. They just stopped inviting us because we were very, very negative about the cannabis industry. And if you recall, every commercial they had at the time was for cannabis. So they initially said, "Well, we don't know what you're doing. Top 3 picks can't be a cannabis short." And so we said, "Fine," but then we talked negatively about it during the show. They didn't like that very much either. But
you've set their advertisers, right?
Yeah, but no, I was on that very early. My family was actually in the commercial greenhouse business, and so even before they were legalized, I said this is a very difficult business to be in. I don't think people realize how tough it is to make money in this. And when we met with the management teams of all the major players, they were like, "Oh, it's a weed. How hard can it be to grow?" I was like, "Yeah, good luck on that."
First-hand experience. What will it take for BNN to have you back on the show? Right, it's been years.
I don't know. They do let me back occasionally, but only in limited doses.
So what's the best part about your job, Jerome?
I'll tell you what it is. I actually started as an economist, and
Interesting.
Worked for the Ministry of Finance, and I was on this committee that handed out industrial R&D. And so we used to go and visit companies all the time, and I used to love to go and visit them and find out what made companies tick. And then that's really what I love about this job today. I still have that buzz and that fun when you meet with companies and you talk to them and you try and figure out what makes these companies work and what doesn't work for them. And
there's so many dots to connect, right? I can really tell that you enjoy doing that and you have a knack for it, right? So many variables.
It is, yeah. And, sometimes there's an element of luck in this game and in life. And other times you just see, people are well suited and they have a good plan. It's just like things are really logical, and you can see why successful companies are successful. And sometimes you can see why unsuccessful companies are unsuccessful. And it's nice to be able to benefit from both ends of that.
And how do you see Gen AI supporting you in the future and your hedge fund, like ChatGPT, et cetera?
I don't.
Okay.
Yeah. I've been in this business more than 30 years, and I remember people talking about this 30 years ago. Like, obviously the technology has improved dramatically since then, but you know, I still run our portfolios off the same spreadsheet I did 30 years ago. And you know, I don't see how my business has really changed much. The only real difference is that when I first started, I used to get about 2 feet of mail a day from research reports and that, and now it all comes in through email. But other than that, the job really hasn't changed in the last 30 years. It's still looking at companies, trying to understand, you know, how they tick and how they're valued and how people perceive them. And maybe I'm just being naive, but I don't really see IA, especially in the mid cap space. They would just say avoid. Go buy some mega caps in the U.S. I don't know. Maybe I'm just being facetious, but
yeah. Tell me about your favorite investing books of all time.
I tend not to read a lot of them, but I remember when I was an economist, I read Peter Lynch's One Up on Wall Street, and I think that's probably the one that's really resonated with me. And he basically said, invest in what you know. Like, you know, you go, his example, I used to go to, forget what it's called, Supercuts or something like that. And he said he got his haircut there and it was $7 for a haircut. And he's like, I think this is scalable. And so he bought Supercuts for the Fidelity Fund. And in your biggest Fidelity, you can drive the share price.
So if you were to pick one investor then, and possibly it's Peter Lynch, who do you want to have coffee with, dead or alive, who would it be?
Oh, I think I go back farther than that. I go John Maynard Keynes.
Maynard Keynes, and why?
I think he was more a philosopher, sort of political economist, I guess you'd describe him. And
he was a trader too, wasn't he? He was a big time investor, right?
Yeah, he was. Yeah, he lost it all once, but then he made it all back again, I think. But he had a great line, which still resonates to me, and he equated the stock market to a beauty contest. And he said, you don't pick who you think the winners would be. You have to pick who you think the judges think the winners will be. And, you know, that's the key subtlety of the stock market. You know, you can think you own the bee's knees of stocks, but if no one else thinks that, you know, it doesn't work.
Going back to Guardian Capital, right? Like people have to see what you see. And, you know, for years, they might not, right?
Yeah.
Yeah.
15 years later, we're still sitting in the stock.
It's done phenomenal for you. But so to close out, what do you do for fun outside of work?
Well, I play a lot of hockey. I still play hockey 3 times a week, and it's kind of a good release. And it's also amazing how much networking you do through hockey as well. I find that it's just, you know, you usually go for a beer after the game, or on the morning you go and have breakfast afterwards and just chatting with people. And it's just interesting, exchanging ideas. And it's also just a fun way to socialize.
That's a beautiful thing. Well, I really appreciate it. Thanks for coming on the show, Jerome. Have a great day.
All right. Thanks for having me, Robin.